Good morning, everyone. Thank you for coming. My name is David Sandalow. I'm the Inaugural Fellow here at the Center on Global Energy Policy at Columbia University. And today I am delighted to welcome Spencer Dale, the Chief Economist at BP, who's going to talk about BP's Energy Outlook 2018 with a focus in particular on natural gas. BP's annual Energy Outlook is always one of the most awaited events of the year for those of us who pay attention to energy. It's a rigorous and compelling analysis, and we're thrilled to have Spencer here to talk about it. Like all of our events here at the Center on Global Energy Policy, this is being webcast live. We're going to have recordings up on our website and on iTunes. If you are watching online, you can ask questions by Twitter using our hashtag CGEP Events. CGEP Events, and follow us on Twitter, please, at Columbia U-Energy. Spencer Dale is well known to all of us in the energy sector. He is, as I said, Chief Economist at BP. He has a distinguished background. Before joining BP, he was Executive Director for Financial Stability at the Bank of England, Chief Economist of the Bank of England, a number of other distinguished positions. Spencer will talk for about 20 minutes, and then I'll invite our other distinguished panelists to the podium. We'll have a conversation and then throw it open to the floor. Thank you, Spencer.
Thank you very much, David. I'm going to close this screen, and if it all stops, then we're in trouble. But if it doesn't, hey, that's good. Thank you very much, everyone, for sparing the time to come this morning. I really like speaking at Columbia's Centre for Energy. I think the centre that Jason and David and others are building here is one of the most exciting global centres for thinking about global energy matters. You're very lucky to have it on your doorstep. I have to, whenever I can be involved in Columbia things, I try to be, because I think the work that Columbia's Centre is doing is so exciting. So it's a great pleasure for me to be here today. As David said, I'm going to only speak for 20 minutes and try and focus on natural gas. But let me do a 2-minute plug about the 1,000 other things in BP's Energy in the booklet, which I think hopefully you've all got copies of, or there's copies at the back. We produce this every year, not to go out and speak to the general public, but to help our own thinking. I'm part of the team at BP the committee that's responsible for thinking about our long-term strategy, and this is a key document when we're thinking about our long-term strategy. At this point, you may be thinking, oh my goodness, this is really frightening. BP actually thinks it can predict the future and it's basing its strategy on that. No, we can't. We know we can't predict the future. Any single point forecast will be wrong. The value of documents like this, and I think pretty much the value of all economic forecasting, isn't to predict the future. The value of economic outlooks like this is to help better understand the uncertainty you face. And we do that in BP in this year's outlook by a whole series of different scenarios. Don't worry about understanding each of the different scenarios here. The point of this slide is just to show that there's about 6 or 7 different scenarios that we look at. If you like, what-if statements. And if by sort of saying, what if the world did that? Or what if the world did this? Some of those what-if statements lead to really different outcomes. Other ones of those what-if statements don't change things very much at all. And by doing that, you can start to get a better sense about the shape of the uncertainty you face. And then for a company like BP, what we're trying to do is not try and pick one of those scenarios, because any one of those scenarios would be wrong, but try and pick a portfolio of assets which will respond quite well across a whole range of those different outcomes. So a resilient portfolio, and that's what we're trying to think about doing when we're doing it, using this for our own purpose. As I think I may have said this time last year, the value of them presenting it to the public is, I mean, for me, the biggest value is the big danger if you work in any organisation, BP, but pretty much any organisation, the biggest danger is groupthink. So a really good way of making sure you don't fall into groupthink is you present something like this, and people love telling you why it's wrong. And as a result of which, and this is literally true, I will often sit on the plane flying home on a Friday night where I've been writing a big memo to my team saying that there's 6 things that people have told me is wrong this time. Fantastic, right? I'm now 6 times smarter than I was when I went to the at the beginning of the week. So that's code for when we start just talking about this, please feel free to tell me which bits are wrong. In terms of just making the narrative clear for the purposes of today, I'm going to focus particularly on one scenario that we call the evolving transition scenario. And the evolving transition scenario sort of sounds like what the name suggests. It's a sense about the broad path the global energy system is moving along if the pace, if it's sort of technology, government policies, social preferences continue to change in a speed and manner consistent with what we've seen in the recent past. So what momentum have we got? Some of that momentum is an accelerating momentum. Where will that broadly take us? And then I'll then sort of do some what-if statements around it. That's how I'm thinking about this. And one final plug for today's outlook, and then I'll focus on natural gas, as I was asked to do today, is we look at the energy transition through three distinct windows in the energy outlook. So first of all, by who's using the energy, the end sector, then by region in terms of where that energy is being used, and then by fuel, the what. So there's sort of how, where, and what of energy. And the reason for doing this is if you're trying to think about the sort of changing behaviours and energy needs which are shaping the energy transition, thinking hard by sector and by region as well as by fuel is really important. And I think this year's Energy Outlook, I think, has revealed to us quite a lot of more of the underlying drivers and behavioural factors going on, that if rather than purely focusing on fuels. Just as a way of teeing up the discussion on natural gas, in terms of the fuel mix and the evolving transition scenario, renewable energy, shown here in the orange bars, and by renewable energy, we're focusing here on wind, solar, and biofuels. We treat nuclear energy separately. Renewable energy, by far and away the world's fastest growing source of energy, accounting around for about 40% of the growth in primary energy. The share of renewables increasing from about 4% today to about 14% by 2040. Perhaps the other one to highlight here is natural gas, shown in red here. Also growing strongly, far more strongly than oil and coal. Its share surpassing coal by the mid-2020s and converging on oil as a sort of as the most important source of energy by 2040. And natural gas in the evolving transition scenario accounting for around a third of all the growth in primary energy. So renewables plus natural gas, 3/4 of the growth of energy in this evolving transition scenario. One other point is to point out before I jump into natural gas is this strong growth in renewables in particular means that the world is moving towards the most diversified fuel mix it's ever seen. So this chart, for those at the back, this is starting in 1900. So not all my charts start in 1900, but just one to give a sense of historical perspective. So what we're moving towards is a world where we think oil, gas, coal and non-fossil fuels will each provide around a quarter of the world's energy needs. We've never seen in history such a diversified fuel mix. And the importance of this for the energy market is the same as in any other market. If you've got lots of competing diversified sources of supply, that's increasing the competitiveness within the global energy system. And so it's sort of one feature which is coming out of the market. Okay, so the plan was today, because it's short and the panel know an awful lot more about natural gas than I do, it was to focus on natural gas. So I'll try and say a couple of things now before I'm then completely dominated by the panel in a moment on natural gas. Just by what I guess I wanted to do is, let me just, in terms of natural gas, as I said, it's growing strongly in our evolving transition scenario. So about an average growth rate of around just over 1.5% a year in terms of that growth. And the way to think about that growth is what's underpinning it is broad-based growth across both sectors, where the key sectors which is driving that growth in roughly equal magnitudes is both increasing use of gas within industry and gas within the power sector. In terms of the power sector, the share of gas within the global power sector in our evolving transition scenario is remaining pretty flat. But the overall growth of the power sector means gas grows with everything else. It's just rising at the same time, but it's not gaining share. The share's broadly flat. Much of the growth in terms of regions happening within the non-OECD, emerging economies continuing to use gas, both in terms as they industrialise and in terms of the increasing role of the power sector, but also some growth of gas demand within the OECD, particularly here in the US. And that's a story of just increasing availability of low-cost gas, allowing gas in particular to gain share relative to coal in the power sector here within the US. And what I wanted to do is sort of do three things over the next 5 or 10 minutes as a way of sort of teeing up some discussions. One is think about the risks to this outlook. How could this outlook be wrong? And then two questions related to the role of LNG. As the growth of liquefied natural gas develops, what role will that liquefied natural gas play? And perhaps a couple of the challenges that poses particular to US LNG, given the audience here today. So first of all, in terms of the risk, if you speak to more or less, so if you lined up 100 energy experts along a wall, which in itself is a quite frightening concept, but if you did and said, what do you all agree on? They wouldn't agree on many things, but I think pretty much the one thing I think many of them would agree on was that natural gas is likely to go strongly over the next 20 years, 25 years, particularly strongly relative to oil and coal. So if you have that sort of consensus and you have a job like mine, the natural thing is to say, well, where could that be wrong? How could that be wrong? Because that's the whole point of understanding this sort of uncertainty. Now, as a way of trying to get our arms around this, we thought, well, rather than splitting up the sources of demand for gas in terms of which regions are consuming it or which sectors, let's split it up in a different way, just as an arithmetic device. And I split it up in these two components here, switching and other effects. So switching refers to that growth of natural gas, which is coming about by gas gaining share relative to coal. So just as a pure arithmetic thing, it's gas gaining share relative to coal, and also a little bit here, but not very much. Also gas gaining share relative to oil in the transport sector. And the other effects are, not surprisingly, the other bit of growth which is left over. And very roughly, about half of the growth in natural gas in our evolving transition scenario reflects these switching effects, and the other half are other things, particularly just the overall growth of GDP and the growth of energy demand. Now, when I think about those switching effects, some of those switching effects, the economics or the mechanisms underpinning it, some of it is pure economics, particularly in countries like the US, where the increasing availability of low-cost gas just allows gas to gain share relative to coal. That's true in the US and in some parts of the Middle East. But some of this growth this sort of switching between coal to gas comes about by increasing environmental policies. So environmental policies around the world encouraging a switch away from coal into cleaner, lower carbon fuels, natural gas, as well as renewables. So the question is, well, what happens if that fails to materialise? Suppose that environmental policy doesn't come through like we think, and as a result, coal is stickier than we think, and there's less growth for gas to come through. What impact would this do? Could this really have a big impact? So what we did is we said, suppose there is no coal to gas switching anywhere in Asia or the EU, the two regions where that type of switching is most pronounced, and also no oil to gas switching anywhere in the transport system, just to get us a sense about what impact that will do. And the story in that case is it reduces gas demand by around a third. So rather than growing close to 1.5% a year, it's going closer to 1% a year. So it's taking out a significant part of that gas demand. So there is exposure of natural gas to that sort of failure of environmental policies to tighten as much as we think. But it's still, a 1% growth rate is still significantly stronger than we'd expect to see for either oil or coal. So it's remaining relatively resilient. If you flip to the other side, and just very briefly say, flip to the other side, well, rather than environmental policies being weaker than we expected, what happens if they're stronger than we expected? So renewables get a stronger push than we think. If renewables are pushed harder, that may then squeeze out natural gas. At this point, I'm going to have to just give you very brief summaries here. The renewable push scenario in the middle bar there, in the lilac one, is an alternative, another scenario we look at in the Outlook, where we say, rather than government support for renewables being gradually phased out, let's suppose it remains at the current levels all the way through. So just think of this as a far more stronger government support for renewables. And in that scenario, you also see gas demand being squeezed, and broadly by a similar amount. So you can it gets squeezed in both sides. The other two scenarios of weaker growth at the bottom there are scenarios designed around trying to achieve some of the Paris climate goals, where you have far stronger pushes in terms of both environmental policies and in terms of improving energy efficiency. The even faster transition scenario right at the bottom is a scenario where you can think of it as being broadly consistent with achieving the Paris climate goals. And in that scenario, you sort of get hemmed up with a world where the level of gas demand today is broadly similar to, the level of gas demand in 2040 is broadly similar to the level of gas demand today. So if you like, there's a sort of Goldilocks aspect to natural gas demand, where you don't want environmental policies too loose, and you don't want them too tight. And on both sides, there's a potential exposure or risk to gas from natural gas demand. If they're too weak, you don't get that coal to gas switching. If they're too strong, you can get this push from renewables coming through and squeezing gas on the other side. That was sort of the risk to gas in a very quick time. The other sort of thing which is just defining global gas markets now in real time, and will continue to define global gas markets going forward, is a massive growth of liquefied natural gas, LNG. We expect liquefied natural gas, the supplies of LNG, to more than double over the next 25 years out to 2040. The two countries emerging as the dominant suppliers of LNG being the US and Qatar as the two sort of key suppliers on the supply side. On the demand side, Asia being the key markets, particularly in the past, the conventional markets for LNG being Japan and Korea, but in terms of the growth markets going forward, China being most dominant, and some smaller Asian economies, Pakistan, Bangladesh, also emerging as important markets. So the chart, I have two charts I wanted to do, just two questions. One about, so the two questions is, there's two major markets for LNG, Asia and Europe. And I wanted to sort of tell a story, just explore how could those markets evolve going forward. So the first one is the Asia story. And what I wanted to do is to ask this question is, how much demand will there be for US LNG in Asia? So again, and you'll conceive, there's a trend to how we do these things. I've done something really simplistic here. We're relatively simplistic at BP. So I've done something relatively simplistic here. I just added up here all the LNG exports of countries who are closer to Asia than the US. So I've just said, who is closer to Asia than the US, and so at least has a transport advantage relative to Asia. And these are those countries there. The dominant one here being Qatar, which is the dominant part of that Middle East, also seeing growth in Australia and so on. So that's just the growth of LNG in countries and regions which are closer to Asia. Well, how does that compare to the gross Asian imports of LNG? That's shown by this line here. So taken very simplistically, it suggests, well, there's not much room for US LNG until you get out to the late 2030s. Now, you shouldn't take this exercise as a realistic thing. This is highly, highly stylized. In reality, all these other flows will be far more diversified around the world. They won't all go to Asia. So there will be US LNG flowing into Asia, of course. But perhaps two sort of messages to take from this is the degree of pricing power that US LNG exporters will have in Asia is likely to be relatively limited if you sort of believe this type of analysis. Because if you try and have too much pricing power, there's a whole set of exports that that can go into Asia, which is closer to Asia than the US is. And so this may sort of limit the degree of pricing power if you do this type of exercise. It also says that US LNG is pretty exposed to any risks here. So, for example, suppose Qatar were to expand their LNG exports by more, so those bars got bigger. Or suppose, for example, China failed to move away from coal into gas as much as you thought. That black line goes down. On either one of those, either type of that supply risk or demand risk, the country most exposed is US LNG. And so there's sort of those risks to US LNG as being the marginal supplier of LNG into Asia, coming sort of showing by this chart. And those lines are sufficiently close, suggest that sort of movements on either one of them could have implications. Very final thing I wanted to look at was just what role we're likely to see in Europe. Now, there's a better way of showing this chart. I should be able to find a way of building this chart, but I haven't worked out how to do it yet. So let me explain how to read it. The size of these bars shows you total gas consumption in Europe. And the different components of these bits are the sources of those gas supplies feeding Europe. And so first order, gas consumption in Europe is flat, right, to first order extent. Those bars aren't doing very much. What is doing quite a bit is the amount of domestic production. That's shown in the red bar. So in 2016, around half of Europe's consumption is domestically produced, half of it's imported. Those red bars gradually decline because US gas production European gas production is declining. So by 2040, Europe is only producing around a quarter of its domestic gas production, having to import 3/4. You can see today, in terms of those imports, the vast majority is provided by Russia via pipelines in those purple pipelines, some via other pipelines in grey, and some via LNG. So the question is, how much of this increasing imports into Europe will be met by Russian pipelines, and how much by LNG? In terms of pure competition, if you're doing this purely in terms of economics, Russian pipelines are going to win hands down. They have enormous amounts of low-cost gas, and they have huge pipelines going into Europe, so they have a huge competitive advantage. But at the moment, the main constraint on that is an energy security issue. And the energy security issue is, in Europe, is, look, I don't want to be really exposed to just one producer of energy, one supplier of my gas, so I need to have a diversified source of supply because I'm worried about this security dependence. The issue with that is today, and last year, and the year before, and the year before that, Europe imported a far greater share of its oil from Russia than it did gas from Russia. When I go to Brussels next week, nobody in Brussels will say to me, Spencer, I've got a real energy security problem with all this oil I'm importing. I'm really worried about it, even though they're importing a far greater share. Why? Because there's a global market for oil. So they know if anything happened to that oil, it's okay because there's a global spot market for oil. I can go and get that global. I can go to the global market and get that oil. Because of that, I'm pretty relaxed. I can just get it from my neighbour who happens to have lots of oil exports. Guess what? There's now a global market for gas due to the growth of LNG. So the story here, which is underpinning this outcome, which is a rather stylized outcome, is that Europe responds to that. So what it does is does two things first. It solves, it makes sure it has an internal market for gas by making all its interconnectors across its country works. And then it builds a load of LNG facilities or regasification facilities around its coast, and it just leaves them there. It doesn't use them. It's an insurance policy. And as soon as it has that insurance policy, it can then go to Russia and say, thank you very much. I can now buy my gas from you, Russia, because I know that if anything were to happen to that, I can use my LNG regasification facilities to get that gas from the rest of the world. Dependence isn't defined by where you buy your product. Dependence is defined by your ability to switch if you need to. Each week, at the beginning of the week, I fill my car at the same gas station at the beginning of the week for my commute because it's the end of my road. But I'm not dependent on that gas station. If anything happened to that gas station, there's 2 roads down. It's fine. I can easily switch. I buy all my gasoline from one station, but I'm not the least dependent on it. And the same sort of logic may well apply in terms of the ability of Russia to compete with Russia's exports into Europe. I have some other stuff. I'm going to stop because I'm going to run out of time. So let me, well, that's interesting, but I'm going to stop there. Let me stop, and then I'll hand over to David for the panel discussion. Thank you very much.
Thank you, Spencer. That was tremendous. We have two other distinguished panelists joining us. To my immediate right, we are joined by Tony Yuen, who is the head of energy strategy with the commodity strategy group at Citi. Did I get that right, Tony? Great. He advises funds, pension plans, corporations, national oil companies, and governments on energy strategy. His experience spans a broad spectrum of the energy and environmental sector. Before Citi, Tony worked at McKinsey, Constellation Energy, and has previously held teaching and research positions at the University of Pennsylvania and, most important, at Columbia University. Teri Viswanath, say that right?
You did.
Excellent. Is managing director of North American Gas at PIRA. She joined PIRA about a year ago from BNP Paribas, where she was director of natural gas research in the firm's global commodity strategy team. She currently helps develop PIRA's view on gas prices, and her career spans more than 2 decades and includes senior positions with Credit Suisse, Deutsche Bank, Citadel, and Dynergy. So we have really an all-star team here to talk about natural gas, and we can even broaden out a little. But let me just start by asking Spencer some follow-up questions and see what Teri and Tony have to say. And let's start with the United States, since we're here in the United States. And Spencer, could you just talk about the U.S. supply story and how you see that evolving in the decades ahead? What do you see as the mainstream view? What are the risks in either direction with respect to U.S. gas supply?
So I think the mainstream view, which is the one built into our evolving transition scenario, is U.S. shale gas becomes sort of just liquefies the global market for gas. We have US shale gas growing very strongly, being one of the major sources of global gas growth over, I think I'm right in saying in our evolving transition scenario, US gas accounts for around 40% of the growth in global gas supplies. And such that by 2040 in our evolving transition scenario, US gas accounts for around a quarter of the world's total gas production. To put that into context, by 2040, the second largest gas producer, Russia, is about 15%. So just clear air gap between the importance of the US as the major gas producer in the world and the second most important one. What underpins that is, I think sort of 2 or 3 things. One is the enormous gas deposits available in the US, the ability, the assumption that the productivity and the efficiency with which that gas extracted continues to improve, and that gas is then distributed around the world. So if you didn't have those LNG exports, that gas would tend to be would get shut in a lot more quickly because prices would have to fall. So this is by spreading it across the world. That's a big that's an important in terms of being able to get that growth out. So what could cause this to go wrong? One is if global demand for gas was weaker than we thought, would be one potential risk. A second potential risk is it gets squeezed by other major LNG competitors like Qatar, which we were talking about a moment ago, and in terms of that sort of balancing effect in the Asian market I was just talking about. And I guess the third one, which Teri and Tony will know far more than I about, is just in terms of domestic infrastructure. For the US gas to remain competitive, the infrastructure that gets the gas from the point at which it's produced from the wellhead to the coast has to expand at the same rate as the production is having to expand, and that's tricky because that's pipelines and that has all sorts of planning and permit issues and so on. So there's a couple of threats: demand threat, supply from alternative country, particularly in my mind Qatar, and domestically the ability for the infrastructure to sort of expand at the same pace as production.
Teri, your thoughts on that?
So, I think that's an interesting story. And so, what could go wrong? why couldn't the U.S. possibly develop as fast as it could? I think that kind of leads down into some of the notions of resource constraint too. So are there any constraints to resources? We mentioned logistically getting gas where we need it. Now, where we need it is on the coast. So if you're going to get your hydrocarbon out of the water, whether it's a hydrocarbon product in the chemical industry or if it's the fuel itself, you got a real problem that these pipelines in the U.S. tend to telescope. So, we've been producing from one area and kind of pushing the gas into the Midwest, into the Northeast. But when you want to bring it back down into the Gulf, they have a problem of actually telescoping. So there's some limitations that we need to sort of address to get as much gas into the global market. Moreover, these numbers, when you think about the massive amount of pipeline development that's occurred over the last decades, we spent a lot of money on infrastructure. Problem is a lot of the pipe was in the wrong location. We thought we were going to get the gas in a different location and source it to a different area in the U.S., not to be exported. It's a bit of a problem. And also in terms of overall, greenfield development. So we've increased our gas pipeline system over the last decade by 170 BCF a day, but deliverability's only increased by a little over 20 BCF a day, and that's a problem. So infrastructure is an issue. If you want to get the lowest cost gas, it's coming from these shale oil plays, these fields in West Texas and Oklahoma Scoop Stack and Colorado. And when we think about the delivery here, they're very challenged getting the gas over to this very small footprint, which is going to be on the east coast of Texas, west coast of Louisiana. It is a challenge. So there's infrastructure. And then also just that resource constraint, that idea of, all of a sudden, I used to work for BNP Paribas. BNP Paribas is no longer going to finance shale. Okay, well, we had that problem occur in coal, and it became a problem. If we no longer can finance, it might be an issue. And these issues related to resource constraints with regard to environmental factors. So earthquakes, right? I mean, that's another problem that we need to think about, David. So I think, part of it, earthquakes, was just an injection well. Now we're getting closer in terms of well spacing. You get closer to the geologic basement, the bedrock, and we run into problems with regard to seismic activities. So
and why isn't BNP Paribas financing shale development now?
Having left the bank, I think part of it is just, I actually brought that up, didn't I? So, okay, totally. What was I? Moment. Okay. I think
you can always say no comment. But
right? I know. It's a sensitivity. Certainly, the sensitivity maybe in Europe about shale development, right? So it is. We're drawing a lot of water. It is a heavy intensive. We are seeing seismic activity. So there's some real concerns about what that means. And, flow back, even this. So you put a lot of water down a hole. That down hole, you get 30% flow back, and it flows back with the chemicals you injected down in those, and then also naturally recurring radioactive material. What? So, I think it's just there's a lot of sensitivity around it, and there's one bank that has actually sort of been out there and saying it's going to be an issue. But, financing fossil fuels, is that a concern? We've seen it in coal. Is it now an issue?
Can I just, so I know nothing about PNB Paribas.
Thank goodness.
So know nothing about banks. And just a sort of global perspective here, two potential risks. So there's a sort of domestic water issue, and which Teri just spoke about, and that's the issue. But two other dimensions why you may be, or important to bear here, is that growth of gas, particularly that growth of US shale gas, is playing a huge role around the world in reducing carbon emissions. I think it's really important. So in terms of doing good, that US shale gas is doing an enormous good because it's one of the key drivers which is allowing the move away from coal. If you did not have that plentiful available supplies of natural gas, the ability to the world to move away from coal would be an awful lot less. So in terms of doing good in terms of that climate carbon, I think it's almost unambiguous that US shale gas is doing an awful lot of good over the next 20 years. The other point just to note here is, even in that even faster transition scenario, entirely consistent with to meeting the Paris climate goals, the amount of gas the world consumed in 2040 was the same as the amount of gas the world consumes today. To produce the same amount of gas in 2040 as today, you need to carry on investing in natural gas. So two potential risks: we don't need that investment, or that investment's not doing good. I think you can put to bed.
I want to get to Tony on pricing in a minute, but just on your unambiguous assertion with respect to carbon emissions, the two pushbacks that I hear on this are first that shale development in the United States has displaced coal here, but it's also led to increased coal exports, and the coal's being combusted abroad. So on a global basis, there may be an increase in carbon emissions, or that tends to affect the reductions. That's point one, and of course point two is methane leakage, where we don't have good data. So any thoughts on that?
So on the first one, if you go back to 2012, where there was a crowding out of domestic coal consumption here because of growth of natural gas, what you saw is the growth of coal, the coal consumption fall in the US here at that point was more or less matched 1-for-1 with increased exports to Europe. In the last 2 years, domestic coal production as domestic coal consumption in the US has fallen, domestic coal production has fallen almost in lockstep. So you do not see that going through. In terms of methane leakages, I think that's absolutely right. I think it's incumbent on all of us. I think our best guess at the moment is those levels of methane leakages still mean that gas is unambiguously better than coal. But I think we need to do, the industry, and BP is trying to take a leading role in this, is trying to do better at both measuring methane leakages and trying to do our best to reduce them to the fullest amount possible.
Great.
I think you make a good point. I think part of this too, David, to your issue is that, we think about this in the industry as, wow, natural gas is twice as clean as coal. But, it's really funny, the side, especially when you heard a lot of the large, the global majors talking about their interest in natural gas, I heard of the sideline on one press guy said, great to hear, twice as clean as coal, but maybe it also, the flip is it's only half as dirty. So in the U.S., given how much gas-fired generation already built, this is Tony's area, already built, we're looking at you're going to have 500 gigawatts of installed gas capacity, 260 roughly of coal and about 100 of nuclear capacity, both of which is aging out. But the problem is you get to a point where you now have 50% of generation possibly coming from natural gas. It wasn't okay in the 1990s when 54% of generation was coming from coal. Is it now okay, or does it now look just half as dirty?
Well, so we may come back to this in the question and answer period. Let me ask Tony about pricing. So, and Spencer has some interesting slides, and particularly talking about the growth of LNG markets. Are we moving towards a point where there's going to be a single global natural gas price because of LNG markets, or is that never going to happen?
Well, sure, it's getting close, and price certainly would compress to price spread would compress to transportation costs. But I think one of the things is that we can find the opportunities among all these discussions about whether you're pipeline bottlenecks and whatnot. Because what happens is most people focus on Henry Hub price, which is perhaps $3 forever, might be slightly below $3. But then, infrastructure certainly seemed to be a constraint, but then gas production is still extremely strong. So that producers are able to produce some gas, and if you are able to get the cheap gas, that means that you are not getting $3 gas, but let's say if you have direct access to, let's say, West Texas, you might get $2 gas or even less. And that means that has an impact on global gas pricing. Because what you have is not all the LNG terminals exporting US gas go through Henry Hub or get Henry Hub pricing. You might go through some of the locations. So then your delivered gas costs, in the past, if you base on Henry Hub price, would be, call it $5, $6, $7. But if you go through West Texas, you might be $1 or more below that. And then the other portion is how Eastern Australia gas price is going to affect global pricing, because now, roughly export and domestic consumption in East Australia is roughly half and half. And so then there's also an interplay between the domestic market in Eastern Australia versus the global market. And so now you're getting towards a much more highly competitive gas market, which is quite interesting to see, and lots of opportunities.
Spencer, you agree with that?
Yes, and I was just writing the notes about the ability to. I think I often fall foul of the point that Tony said you shouldn't do, which is sort of doing a cost markup over Henry Hub when thinking about global prices, and the recognition that some of those gas feedstock may be coming in at significantly less than that, I think is an important issue. And I guess the only other point I would add is, I think it's consistent with what Tony just said, is in my sort of stylized view of the world, I have U.S. Gas prices acting as a sort of the anchor for global LNG prices around the world. So I have a sort of crude story in my head is pick Henry Hub. I'm not as brave as Tony to put a number on it, but pick whatever number you want for Henry Hub. Add $3 liquefaction, but you add $2.5 transportation costs, and that gets you to a number in Asia. And then you perhaps have $1 less into Europe because the transportation costs of shipping LNG from the US to Europe is $1 less. And so that gives you a structure of sort of a plus 5.5 into Asia, plus 4.5 into Europe. The challenge to that would be that Qatar story I was telling you about earlier. If Qatar grows sufficiently strongly, then the ability for the US to charge $1 different between the two may start to become challenged, because Qatar is sitting between the middle of both Europe and Asia, and if they can actually act as, if you like, the supplier of last, as sort of the marginal supplier, then that differential that most of us have in our heads of a sort of that transportation cost, which Tony which is sort of the $1 fee, that may be challenged if we see enough growth of gas, particularly in the Middle East, and particularly in Qatar.
Teri, you want any comments on that?
So I think that's interesting, because one interesting point that Spencer has talked about in the broader outlook happens to be that natural gas is going to be the fastest moving demand growth segment of the fossil fuels. But the thing is, with global gas, if we're not producing as much oil, then by definition we're not going to produce as much of the natural gas. So, I mean, that's kind of a problem, which means you're going to have to get back to gas economics at one point in this discussion. So Qatar can produce all the gas it wants if it finds a home for the condensate, yeah? And it can do it freely. And we can produce all the gas we want as long as we find a place for the Permian oil. But when we get to a point where we don't need the oil, well, you're not going to be producing as much. You're not going to get this associated knock-on effect. You've got to get back to dry gas economics. And frankly, it's a different story we tell over the long run. So I think those economic choices right now are kind of muted. For every 1 million barrels of shale oil we produce in North America, we're kicking out about 2.5 to 3 BCF a day of gas. Byproduct gas that needs to find a market. And that event, with producing so much oil right now, certainly is going to, and you provide the LNG capacity, wow, you've got a market that looks like it's got a lot of gas, right? But there's a point in time, certainly post-2025, you begin to see that tapering growth in shale oil for sure. You have a problem, I think, and we got to get back to dry gas economics again.
Let's do a tour of the world, and we were in the United States. Let's go to China. Tony, I think you pay attention to what's happening in the China market. Any thoughts about both demand and supply in China? There have been striking developments with coal to gas switching in China in the past couple of months. What are your thoughts on that? And turn to Spencer as well on that topic.
China is such a spectacular market, because this winter basically prices doubled. Went from about $15 to about $35 per MBTU, and then right now come back down, right? And China is also a place where when they do something, they do it with a revolutionary zeal, right? So when I want to do a coal to gas switch, so all the downstream boilers, let's do gas boilers, dump all the coal boilers, and suddenly, oh, there's not enough infrastructure to get the gas to market. And so then they kind of, pull back on some of the coal to gas switch. And this is where, Spencer talked about the Goldilocks scenario is quite important in China too, in that if you push too hard, there's a shortage. If you don't push it, there's not much incentive, because if you look at cost of gas in China, Citigroup, is actually still higher than coal. And so policy has been extremely important in pushing for gas consumption. Now, there's what we think perceived to be a rethinking about, how much would you do this coal to gas switch? Can we do more coal to electricity switch, which is a parallel initiative? And then coal to electricity might actually be advantageous in several ways, right? One is, building gas infrastructure is not easy, but electricity, China is basically all electrified, right? So it's much easier to get the energy through electricity. And China is also aiming to be a clean energy superpower, solar, wind, batteries, whatnot. They control the battery, material market among with Japan and Korea as well. So why not? So I think that's probably a question of what's gas long-term role in China? Is it going to be growth as strongly as what we've seen the past couple of years, or is there going to be a slowdown down the road?
Spencer, anything to add to that?
No, I guess just two other points. I think when many of us think about coal to gas switching, the natural space you think about it is in the power sector. What was striking most recently in China is the point that Tony is making. All this coal to gas switching wasn't happening in the power sector. This was happening in terms of domestic boilers. And I think this is right. I think it's considered what Tony said. The strong incentive from governments was you must move away from your coal boilers, either to gas or to electricity. I think it was relatively technology neutral, but what happened was everybody went to gas, and there was this huge growth. The spike, an interesting question, is the spike telling us this is unsustainable, or is the spike just telling us this is teething problems until we got the infrastructure sorted out? And they have made, as I understand it, a whole series of policy measures post that spike to try and mitigate the extent to which you have spikes in the future with mandated levels of storage levels and so on and so forth. The other interesting question, just briefly on the supply side, is how much of the gas will they be able to produce domestically versus have to import via LNG? And Teri, I'm sure you know far more about this than I do, but they do have shale gas deposits in China. Except, now I'm an economist, I know nothing about geology, but people who tell me, who do know about geology, the geology of that is far more challenging than the geology than anything here in the US. The issue here is, it may well be, it's conceivable that the economics means you don't fully exploit. If pure economic terms, you may not fully exploit all that shale gas in China. But in China, it may be that you do exploit it more than pure economics would say, because there's an energy security issue here as well. If you can supply more of that gas domestically and so reduce some of your dependence on imports, that may be a price that the Chinese authorities are worth thinking about. And I think it's China more than anywhere else where those energy security things may sort of trump or at least overlay pure economic thinking.
And if you're interested in unconventional gas production in China, you can look at a report that we did on this topic at the Center on Global Energy Policy a couple of years ago, which we're currently updating. Let's move to India. Is India going to emerge as a major gas consumer in the years ahead? I don't know, either Spencer or Teri, any thoughts on that?
In our involving transition scenario, there's a global, India's gas consumption more than triples. So you say, wow, that's increasing a lot. But its share within overall energy is not increasing very much at all. And that's just because overall energy demand is also increasing a lot. We're seeing the challenge, I think, to building a big gas-based economy in India is the role of gas within the power sector. And I think the authorities have made very clear that they have an ambition to increase the role of gas within the power sector. The challenge is a squeeze they have by very strong growth in renewables and the availability of relatively low-cost coal. And that's quite a hard thing for natural gas to get through. And I think it's conceivable it gets through, and the government in India has made very clear its determination to do it. But I don't think it's going to happen naturally. It will need some policy push to get a sort of significant increase of gas consumption within the Indian power sector.
It's a fun story to think about because, Spencer talked about we now are in a period of abundance, right? And so in a period of abundance where we've had problems of scarcity, we begin to address those issues of energy scarcity. And India is sort of an interesting, it's an interesting story, but, even Mexico, where, you have abundant resources, but Mexico may choose not to develop them because in an age of abundance, when it's cheap, Why would you? There are countries that shut in their gas wells and simply import at this moment, right? So why would you? And that's an interesting story. Even in Mexico, when you think about this, scarcity, addressing scarcity through infrastructure, they have 4 world-class crackers that run at a utilization rate of roughly 25%, and it's all about scarcity. You start to address scarcity, you start to see more energy consumption occur in these areas. Natural gas coming into the market, maybe as a part of this big oil push, or simply because we have a lot of it right now and it's pretty cheap, means you start to see more consumption occur. And it can actually, you can be choosy about your environmental issues when everything is cheap. So when everything is cheap, do you want to, do you want to have this campaign on, we see U.S. consumers, large consumers, your data centers in particular, but they're making a choice on energy. You can make a choice on energy when it's super cheap. And so that's maybe some of it's going on, but it's that abundance versus scarcity and addressing scarcity, I think, which is also at play.
And you see that in the global LNG market. So there's a sort of much misused term in economics, I'm about to misuse it again, in terms of Say's law. And Say's law says the supply will create its own demand. And you are sort of seeing elements of that in terms of global LNG. The huge growth of global LNG supplies in the last few years means at the moment the cost of LNG, particularly in Asia, is sort of below a sustainable level. But they're not. Many of those LNG producers are not fully covering all their costs of capital and so on. But the availability of relatively low-cost gas in itself is starting to generate new markets. You're seeing countries, Pakistan, Bangladesh, starting to consume LNG for the first time. And so there's a sort of, if you like, perhaps a more scientific way of doing it, there's a latent demand there. And that latent demand is being able to be tapped by the growing availability of LNG.
How about Africa? Not currently a major force, but in the 2040 timeframe with all the population and economic growth projected there, what do you see, Spencer, for Africa?
So, largest issue of scarcity.
So there's a sort of fact. I think it's if I gargle the facts wrong here, then it's my fault. Don't quote me. I think something like half of global population growth over the next 25 years happens is in Africa, but less than 10% of the growth of either GDP or energy consumption happens in Africa. As a matter of sort of identity, that just means that productivity is appalling in Africa and remains very low. You've got lots of people, but they're not producing very much, hence GDP growth is relatively weak. And if they're not producing very much, there's not much output per head, they don't have much income per head, so the prosperity is not increasing very much, and you don't get much growth in energy consumption. 2 points though, just those people just getting bigger means that by just the population growth, it means by the sort of the very end of our outlook, the late 2030s, it is becoming a major force. So we have a sort of slight statistical curiosity in some sense. In the last 5 years of our evolving transition scenario, energy consumption in Africa, the growth of energy consumption in Africa is greater than that in China. And I guess the other thing which I think is interesting is when you think beyond 2040, which is sort of frightening in itself, but if you want to think beyond 2040, what happens to productivity growth in Africa, I think, will become perhaps the most dominant factor shaping global energy demand. And I think many of us think global energy demand will be, that growth rate will just keep on declining because China will gradually decline, energy efficiency improves. If you like, Africa starts to wake up and you see some just relatively minor pickup in productivity growth with that much population, that could lead to a huge surge of energy demand growth in 2040 and beyond.
Tony, let's move to Russia and our tour of the world here. Any thoughts or comments about how you see Russian gas markets developing?
Oh, Russia. That's a quite interesting topic. The reason is the following, because one is they are not only, of course, a major dominant player supplying gas to Europe, but then the astounding growth of LNG out of Russian Arctic. They got the project done within 4 years, on budget, on time, we think. And that's basically much better than many other locations. And what you will have is potentially, in the future, 3 major countries dominating the LNG supply. One is US, second is Qatar, and third, Russia. and each of them can produce substantial amount of 100 million tons per annum of LNG. And that these countries themselves can lead the next LNG supply wave. And this, combined with what Russia is doing in Europe, plus trying to get pipelines into China, basically, spreading tentacles. Almost look like it on the map, right? Tentacles, right there, both sides. So, and it is also an interesting aspect in how gas is where three countries, U.S., China, and Russia, they all kind of come to some sort of cooperation in some ways. China's just imported or signed contracts to import LNG directly, and then China getting Russian gas as well, but China also played the both sides, and this is where the fascination comes in.
All right, I want to go to, let's see, South America and then Australia, and then throw it open to the crowd because we've got a lot of expertise in the audience here, but just maybe for some quick comments. Teri, you mentioned Mexico. Do you have any thoughts generally on Latin America and gas markets?
So this is a real challenge, right? Because you also have a resource-rich area of the world that actually really got incredibly in debt over the last, decade leading up to this, energy abundance. So you might actually see more consumption occur on this area of the world than production, and it's an interesting story that I think we have to take a look at. And broader, I think what's, one could also say, what's missing from this is Canada, right? I mean, if we look broader in the Americas, I think Canada is a pretty deep resource base, and why aren't we tapping in? And I'm looking at Madeline and seeing if she's okay with me talking about West Coast 10. Our global economy.
It's fine.
Yeah, okay, great. Okay, we're good. Okay, so I'm going to go with that. So we have two mountain ranges, and the inability of a country to address simply gathering out of the Montney Shale and getting gas into market, flooding the market. They were taking, they were paying consumers to take their gas last fall, okay? And so there is a need for, Canada to play an important role in terms of this LNG story. They need, that's a resource in need of a market, right? But it is problematic. So I think in terms of how we think about this, areas that could produce, but also consume a lot, that's not Canada, but that also consume a lot, that may be consuming more out of the market than we expect. And then Canada really has to get over a policy issue and string a pipe over two mountain ranges to get the gas to the coast, to get it onto the water.
I'm not sure you should be worried. She was nodding halfway, and then she started to shake halfway through.
Yeah.
Trouble now. Tony, you want to come in?
One quick thing about South America is it's actually two very different markets. You have, if you call Mexico part of Latin America, because Mexico highly depend on U.S. gas. Without U.S. gas, country have issues because gas supply basically more than 60% of it comes from U.S. And so that's highly dependent on U.S. gas, and therefore the NAFTA negotiation becomes important as well. But then the other part, which brings to the broader question of how strongly gas demand will grow globally. Because several years ago, people thought, Latin America, particularly Brazil and all those countries, are strong growth potential for LNG, for gas. But also happen to be very low hydro yield, very low reservoir levels. So therefore, if you look at it on data on an annual basis, if you're just looking at it from the outside, it looks like, tremendous growth out of South America. But now the hydro is back, so growth have stayed low, or basically have stalled out. Similar case, what about in China and our locations, where it is right now policy push, and also it was hydro issue last year too. Then afterwards, can gas demand grow as quickly as some people have thought by just looking at data, looking 2 data points and draw a straight line? Now, in my old job, you can take 3 data points and draw a straight line, and that's called your CAGR, and you can have tremendous market growth in the future. Or if you stretch out 10 years, you don't have that much growth. And so it depends on what line you draw, that line or that line. And I think that's probably a deeper sort of re-examination of when we look at gas demand growth, fundamentally, are we seeing real structural growth, or are we seeing something seasonal or policy-driven, or as Spencer in the presentation talked about? How much of it is switching, how much is structural, and the switching part, how much of that can be eroded, because gas price, global LNG price, has a floor. because of thermodynamics causing the transport cost and liquefaction cost to be there all the time, to be a sizable cost component.
So by the way, I'm skipping over Europe because Spencer talked about it in his remarks, not because it's unimportant. It's obviously very important.
Quite right, yeah.
I don't know. Any comments on Australian production and forecast for that? What do you see happening?
In terms of LNG, we see some continued growth of Australian LNG in the next couple of years as just the final things come online. I think there's some scope to sort of add to those existing projects a little bit, but the ability for Australia to expand substantially is constrained, I think, by the relative cost of their gas there relative to and other sort of sources of gas. So some growth, finish off sort of in-flight projects, perhaps building on some of those existing projects a little bit, but not huge expansion beyond that.
Great. Well, let me invite anybody who'd like to come to the microphone and ask a question. Please identify yourself.
Hi, I'm Nico Warden. I work with Copperwood Energy. Thanks for speaking, Tony, Teri, and Spencer. And I had a question about the global supply side of the gas equation. In particular, the United States' basically ability to export technology rather than just LNG, and how that might affect the LNG market. Thanks.
So that's an interesting. So I think in terms of the production, can we actually export this shale technology? It's something that Spencer sort of mentioned. Even if, so we know how to do this, but it really depends on a bunch of other factors. The geology itself appears to be there. It might be at a deeper base, a little bit more expensive, but the wherewithal for countries to actually begin these programs when we've got an abundant, we've got this issue of abundance, may kick that can down the road a bit longer. So I think the ability to sort of take that shale, because there's a lot of shale, right? There are a number of areas that we could see development, but will we, when prices are so low? And I think we kick the can down the road at least by a decade or more.
Does anyone have comments on Argentina? What's happening there?
Not in Argentina. So somebody else. So I'm going to do slightly just perhaps two other dimensions. I agree with Terry in terms of pure shale. There is ability, and we're seeing it happening in real time. BP's doing it in real time, of taking the learnings you have from shale and applying them to other projects. They're not pure shale projects, but you're taking some of that lateral drilling knowledge you're gaining and some of that and putting it elsewhere. So we have a major project that just come on stream in Oman, where we've sort of done exactly that. We are making productive fields, which fields we previously just wasn't. And the one way in which we are doing that is taking the knowledge from our US shale gas business in the US and applying it elsewhere. And that's tapped quite a significant gas production in Oman. And I think one of the benefits of big oil and gas companies being involved in the US shale gas or US tight oil, it's a cutting edge of technology. And what you can do is what we can do easier than small domestic E&P producers is then take that technology and apply it in other parts of the world, not in necessarily pure shale plays, but in other things which allow you to do it. Perhaps just one other point is a point that one of my colleagues have made to me in the past. When thinking about the role of America in sort of the global energy markets and the role of America in terms of energy as a part of foreign policy, I think there's a potential role here of America in terms of soft diplomacy saying, look, we had a shale revolution and it has enormous benefit for our economy. Let me explain to you what factors led to that shale revolution. And some of it's technical factors, but some of it's the rule of law, competition and so on. And sort of exporting that knowledge base as part of soft diplomacy, I think is a potential thing to think about going forward.
For those of you listening on podcasts, that was Spencer Dale of BP just speaking. My name is David Sandalow. I'm with the Columbia Center on Global Energy Policy, and I'm here in New York City with Teri Viswanath of PIRA and Tony Yuen of Citi. Do we have any other questions?
Hello, Gabriel Avgerinos, Energy Mentors International. You've talked a lot about the globalization of energy. One specific question that I had, and I'd love to hear your comments on, is the announcement by China about the global interconnector. Not so much from the point of view of the use of renewables, but from the point of view of what you did talk about, which was infrastructure. Again, not for gas pipelines infrastructure, but for infrastructure required and lacking in many regions for global electricity. The push from China is electricity is going to be the big road for transmitting energy. The problem that we have is we're lacking, even in the United States, or aged, hugely aged, high voltage or ultra high voltage global long distance transmission. Until that happens, you really have remote areas that do have renewables such as wind and solar, or remote areas that might have shale that are captive, that cannot be turned into electricity that then can be moved to the coasts of central populations of the United States, or even in coastal populations such as China. I'd appreciate your comments specifically about that issue. Thank you.
Sure.
Tony, comments on global energy interconnection?
So let's start small first. And the reason why I say this is because China has the most ultra-high voltage transmission lines, and they overbuilt them. And so then the coastal area is actually, somewhat connected with these UHV lines. Lots of renewables in northern tier as well as the western part of China, but then utilization is not that high. And so then there might be, on the rhetoric side, they might be looking to build these lines, but then, one, are we connected to the right place? And the last mile is very important too. Then you expand to the more regional, global level. Yes, you might have lots of energy with, certain parts of China, but then Russia doesn't need the Chinese energy. Not Central Asia, and then some of the coastal South Asia, for political or for other reasons, may not also want that too. So then, then you have to go to Europe, but that might be too far. So I think that's where, I think several years ago, there was this push by a major state-owned company on this, but I think it was more, rhetoric on that front than actual implementation.
Other questions?
Good morning. I'm John Imel. The company is Penn America Energy. We're developing an LNG project in Pennsylvania for export. And so we're very focused on future markets. Have you already baked in, this is a BP question, have you baked into your scenarios the broad adoption of, in some future American administration, carbon taxes that spread throughout the developing and developed world? Is that already part of your scenario planning?
So what's built in to the evolving transition scenario is carbon prices in most parts of the world, and some of it's explicit and some of it's implicit, but roughly, growing to about $40 a ton in real terms. That's what's built in. And I guess the just a caveat here, or the other point to make is, in that scenario, we have carbon emissions continuing to rise out to 2040. In any scenario consistent with getting close to the Paris climate goals, they need to fall by about 40 or 50%. So a clear message from our energy outlook is we need to do more, and we need a far more decisive break if we're going to have a chance of achieving those Paris climate goals. And part of that, and a corollary of that, is $40 a ton real terms is highly unlikely to be a sufficiently high carbon price if we are to get a good chance of achieving those Paris climate goals.
Just to follow that up, is there a price at which a carbon price makes a difference? Is it 60 or?
It makes a big difference, even low prices, and this is really important. So I guess I'm a bit of a bore on this. If you're going to make any difference on carbon, the place where you really make a difference, and this is true in our outlook, but we don't have the oracle wisdom here. It's true if you look at IEA, it's true if you look at MIT. The place where you make a big difference is a power sector. So think power sector once, think power sector twice, think it 3 times. There, carbon prices can make a big difference because you've got fuels and energy sources competing side by side, and small changes in relative prices can have a very big impact. A great example of this, if you want to have a great real-life example rather than economists theorising, is look what happened in the UK over the last few years. The UK remains part of the European trading system, but we put in a floor price for carbon prices and said if the floor price is less than around 20 sterling pounds a tonne, which it has been almost consistently for the last 10 years or so. If it's below less than 20 pounds a tonne, we put a floor of about 20 sterling pounds a tonne. Since we put that floor on, we've seen an almost entire removal of coal-fired power generation in the UK, and that relative price is having impact. So you need to get higher prices if you want to get CCS up and running and moving, but even relatively low carbon prices can start to have a big impact in the fuel mix within the power sector.
Thank you.
Hi, Soren Shaw from Neuberger Berman and SIPA alum. Two-part question, if I may. First, what are your thoughts on Canada? You had mentioned, Spencer, the idea of an insurance policy for Europe. What's Canada's role historically for oil sands as an insurance policy against volatility in other parts of the world going forward, and also for dry gas? What's Canada's role in the future? And secondly, what's your view in terms of baseload requirements, particularly if you're right and the world does electrify? Where is that bottleneck in terms of availability of baseload power? Thank you.
Teri, I'm sure you know far more about Canada than I do. Did you want to do the Canada bit?
And gas person hitting the oil sands, right? No, it's just, it becomes this competitive story, and so is there room for oil sands growth? And that's a real question, right? I mean, it's very challenging in a price environment where you are seeing a lot more. Simply in terms of the economics, where is the drilling at right now? Just follow the rigs in North America, and they're all, well, not all, but mostly in West Texas. So you have such a dominant, and I think that kind of tells us in terms of where our expectation near-term growth should come from. You're just not seeing as much drilling activity, not so much money's been funneled into the drill bit in Canada, and I think that has to sort of limit our expectations on supply growth. And there are some real infrastructure challenges in investment that needs to be made to get that energy product to market, any market.
If I may, on the Canada question, Trans Mountain Pipeline is symptomatic of what's happening in Canada. So it was a pipeline that's supposed to transport oil from Alberta to BC and export it out. Yeah. It's on the verge of not going ahead. Of course, there's a jurisdictional issue between federal government and provincial government. But Canada got this infrastructure issue. Basically, it is, you can almost call it a landlocked country surrounded by the U.S. in that all the energy now basically has to go to the U.S. So despite the abundant superpower, whatnot, talk about Canada becoming on the oil and gas front, infrastructure is the major hurdle. You can't, can't deal with it. I look at, multiple pipelines, multiple years. 2009, Kitimat talked about exporting LNG in 2014. Where's Kitimat now? It's only still there as a town rather than LNG exporter. On the question of baseload, why don't we flatten the low curve? Why don't we use software? Why don't we use renewables and storage? The reason is that if you look at recently, there's some studies done by NREL, National Renewable Energy Laboratory. What you can get is you can flatten the low curve. What that means is that, during the day, electricity, you have to instantly match each other in supply and demand. So typically, in the middle of the day, would be much stronger demand, and then overnight would be much weaker. But then now, you can actually shift your load so that it becomes pretty flat, and then you can store energy during the day from solar, store energy overnight on wind, and flatten it out. So this is something similar to what Spencer's, one of the slides Spencer showed, in that we're at the point where all kind of energy sources have somewhat similar mix of market share, or at least approaching that. So that actually has tremendous impact on investments on baseload power for coal, gas, and nuclear.
Just one other point on the baseload issue. So in our outlook, as I was saying, renewables grow extraordinarily quickly. Within the power sector, renewables are accounting for around half of the growth of global power over this period of time. But their share is only rising on an average, global average, to about a quarter. At that point, the costs associated with intermittency type issues aren't sort of really costly. So there's not a major problem in dealing with intermittency in this scenario over the next 20, 25 years. Or put another way, the issues of intermittency aren't acting as a big constraint on the ability of renewables to grow over the period of time, because it's not that expensive. And sort of, if you like, a somewhat depressing fact here is, despite coal not growing at all, despite the share of it falling quite sharply in China and in the domestic world, in that evolving transition scenario, where half of the growth of renewables, coal still remains the dominant source of energy in the global power system. So there's still a long way in terms of sort of moving towards a sort of cleaner, lower carbon fuel mix within the power sector.
Thank you.
Thanks. So we have about 10 minutes, and I see 4 questioners, so we'll be brief.
Hey, good morning. My name is Rui Zhang. I'm from Alt Air Management Consulting. My question is about the impact of hydrogen economy on the demand of natural gas in China. Because since last year, the Chinese central government is pushing a lot on the so-called hydrogen economy. And we know that 90% of hydrogen is produced from natural gas based on the current technology. So do you have any comments on like how fast or penetration of this hydrogen economy would be on the natural gas market in China?
Tony, any thoughts? Tony, Yuen.
I think you can look at the example of Japan. They really try to push hydrogen, but there are just competing technologies that seem to be better. And then there's Hydrogen Council globally that draw on car makers and energy companies and whatnot. That's trying to do a big push on hydrogen. But then ultimately, you also think back about how do you get your hydrogen supply? You mentioned natural gas. China is highly dependent on foreign imports of natural gas, and there's also a foreign national security issue as well. So then, if they are actually big in batteries, big in renewables and these, so that means that would it be easier and also safer to pursue those areas? While hydrogen, certainly you can experiment with it and see how it goes. Then finally, on the technology front, again, if you look at some of the national laboratories or some of the technology companies, so hydrogen certainly have seen advances on technological front. It's just that others have the economies of scale in terms of other technologies and got a leg up already. So then they are kind of running ahead of hydrogen. So that's why I think that it is interesting topic to continue to investigate, just like thorium and nuclear. It's just that how big it is going to be in the next 5-10 years or so.
Yeah, and Tesla would say that there is no hydrogen economy. So they would be the first to sort of point out that forget about the fuel cells that make absolutely no sense. But Mitsubishi is taking a look at marrying that idea of natural gas more closely with hydrogen in terms of fuel cell usage. And you are seeing application, and Toyota hasn't backed away. So there's something there, but certainly it's cost challenged and supply challenged.
Tesla may not be entirely unbiased when they're in their view on hydrogen. I mean, but I sort of in the same boat as Teri and Tony is. I really wanted to say an interesting story in this book on hydrogen. I really pushed Marcus and my team here. No, I really pushed hard, and I pushed hard, and you won't find an interesting story on hydrogen here. And that's sort of so. I think if there is going to be an interesting story on hydrogen, one area where it may be is the ability of hydrogen to compete against electricity or electrification and potential natural gas in terms of long-distance road haulage. There is, and that doesn't happen in this 25 years I'm there, but that's the bit, I think if you're looking to, and you want to be that's the sort of place where you may see it, but that's quite that's quite stiff competition. Now, it's long-distance road haulage makes electricity stuff harder to work. Natural gas gets you so far in terms of decarbonisation, but not all the way. So you may see it there, but we don't see it in this 25-year thing, despite working quite hard to try and tell an interesting story.
Thank you. Why don't we have all three questioners come and ask your questions, and then we
simultaneously.
Yeah, exactly.
Shut them up.
Perfect. And then we'll have comments.
Yeah.
Then we'll have some closing comments. Please introduce yourself. Thank you.
Good morning. My name is Michael Dobson. I'm a PhD student in the city. I just had a question for the panel. Whether or not you guys think the green paradox is something real, which is to say, as the Paris Agreement becomes more credible, as governments around the world bring in policies directed at transitioning away from fossil fuels, do you see that creating an incentive for fossil fuel owners now to try to extract and develop those resources as quickly as possible?
Great, thanks. Akash.
Akash Loss with the Center on Global Energy Policy. I have two brief questions, both related to LNG, if I may. So first of all, we heard a lot about Qatar, Russia, and the US as being the dominant sources of new LNG supply, but I'm curious to hear your thoughts about the potential of East African LNG resources. What role can they play in the future of LNG? And then my second question is related to this evolving narrative of LNG market oversupply. You know, market analysts have been predicting this for some years, and now that demand actually turned out to be enough to absorb all this new supply that's coming to the market. Some people are actually calling off this whole narrative about oversupply and suggesting that it will not come at all. But as we could see, there is still plenty of supply looking for a market. So my question is it too soon to call off the oversupply narrative?
Thank you.
Hi, my name is Rafia Merchant. I'm covering energy finance for Bank of China. So this has been a very, very helpful presentation. Thank you, and particularly the world tour was very, very interesting. My question has to do with the energy reform in Mexico. I know you guys touched on it a little bit. I think I was very interested in just hearing a little bit of your view, given the imminent presidential election coming up this summer. And secondly, I wanted to understand, just in terms of maybe not through 2040, but just in the next 3 to 5 year term, as the markets open up there, or fingers crossed open up there, do they really have the infrastructure there to allow for that opening of the energy markets there? Thank you.
Thank you. All right, so we have 4 questions, 3 speakers, and 6 minutes. So our topics are the green paradox, East Africa supply, LNG oversupply, and Mexico energy reform. If you would take whatever question you want to take, duck whatever question you want to duck. And we'll start with Tony, go to Teri, and Spencer can close it up.
Sure. Green paradox. Low-cost producer, yes, you want to monetize it. High-cost producer, no. Because in oil, you see, potential OPEC countries, some of them have to thinking of let's monetize that oil. But then if you look at the case of coal, not really, because coal mining cost is pretty high. So you are actually seeing not only financing issues, but actual slowdown in coal supply. So basically that paradox is really commodity dependent. LNG East Africa, there's a price and policy issue. Russia, Qatar has policy support. The US is easy and cheap. East Africa, you kind of take a leap. So, of course, certainly you need super majors to really try to push it. Let's see how it goes. But, my bet is more on Russia, Qatar, and US. Strong LNG demand, LNG oversupply issue. I think the major issue is, are we seeing actual structural growth? Or are we seeing, some that this growth spurt, and then that might be something that derailed it? Over the last few years, the credit rating of the LNG buyers have deteriorated a lot because now you're expanding into countries which have really bad credit ratings. And then you are also looking at multiple sources of new energy coming in that's competing with gas. As I said before, LNG have a price floor in that there's thermodynamics, mixed transport, and also liquefaction costly. And so there's only so much gas price can go. Mexico energy reform, infrastructure. The issue is the presidential election probably, will potentially mark a somewhat change in energy, the way how energy market looks like. But it might be coincidental because if you look at recently the bidding rounds of offshore in Gulf of Mexico, it's been tremendous response. It's just that offshore is great, onshore not so great. As Teri said, you might actually import more. It's cheap. Electricity side, they try to do some bidding right now, but it's not so good. But then Mexico's energy sector is definitely liberating. Power trading is coming.
Tremendous. Teri, Viswanath, why don't you pick whatever question in 1 or 2 minutes?
Yeah, exactly. So LNG's the surplus is conspicuously absent. That is a Shell discussion, but I think they're kind of like Tesla. They may have a dog on that fight. So I'm just thinking, so conspicuously absent. But here's the funny thing. So you hear these stories. Australia, $20 per MMBTU. They don't have enough gas domestically. In fact, there's a Japanese consortium looking to sell the gas back. The key point being, a Japanese buyer bought too much and is willing to sell the gas back to Australia. That is not a good sign that there's not a glut that's developing, especially with all the projects coming in 2019. Energy reform in Mexico, I love this story, and I do think it's real. I think with the transportation, keep in mind, CFE is going to be opening up an exchange. They're going to be trading and transacting. There's an ability to do deals here. Also, on that pipe, if you reserve the pipe and you don't use it, you know what? You've got to give it back to the market to use that pipe. The ability to transact in Mexico, the ability to move molecules on those pipes makes this real for me. So I'm really excited about what's occurring. We've got to get that backbone. We're 180 days delay on every single Mexican project. Ugh! When it comes in, it's a real market.
Spencer Dale, the last word is yours.
Can I just say, as somebody who's literally just about to go on a world tour, sitting here doing the world tour is a lot more fun than doing the little world tour. I haven't heard the term green paradox, but the idea of abundance of energy and the need for the challenge to monetize your energy assets, I think is really important. At the risk of doing a naked plug, I just wrote a separate paper on this with Basram Fatou, which you can get from bp.com, or if you come down the front, I think we have a few copies down here, there's a nice lady here. And the point there is, you may want to monetize your assets and produce more, but your ability to do that may be constrained by the macroeconomic structure of your economy. So it may be more subtle than a simple paradox, and I haven't got time to go that, but please do read the paper and let me know if that helps you. East African LNG, yes, we do see some growth of East African LNG. The glut thing is interesting because everybody, 2 years ago, this year was the year of the glut. And it hasn't happened, and it keeps getting pushed out. Some of that's demand, but some of that's supply, in the sense of some of the projects which I think, the US LNG projects which were scheduled to come on stream this year, have now been pushed out a little bit, and that's markets working. So we haven't had quite the extent of that glut we thought, although I think the fact that if I look at prices in Asia and Europe over the recent past, they are not fully priced LNG contracts. So some elements of that glut is there, even if it's not quite as extreme as many people had expected.
Yeah, good point.
Spencer Dale, Teri Viswanath, Tony Yuen, this has been a spectacular panel. Thank you for your insights. Please join me in giving them a big hand.